Hi everyone. Today we're going to be working with Financial Accounting Chapter 2, Measuring Business Transactions. Our learning objectives for today are to explain how the concepts of recognition, valuation, and classification apply to business transactions and why they're important in ethical financial reporting. 2, to apply or explain how double-entry accounting works and how T accounts can help us analyze business transactions. 3, demonstrate how the double-entry accounting system is applied to common business transactions. And then 4th, we'll prepare a trial balance and describe the valuation and limitations of a trial balance. 5th, we'll learn about the chart of accounts and how recording transactions in the general ledger and posting transactions to the general ledger relate to the chart of accounts. And then lastly, we'll show how the timing of transactions affects cash flow and liquidity. So first, let's look at the measurement issue. In this, we're going to explain how the concepts of recognition, valuation, and classification apply to business transactions and why they are important in ethical financial reporting. So, the role of the measurement issue. Business transactions are economic events that affect the financial position of a business entity, a company. To measure a business transaction, an accountant must decide and answer 3 primary questions. The first one, recognition. When did the transaction occur? When should we recognize that this transaction occurred? The second question, what value should be placed on the transaction? And third, how should the components of the transaction be categorized? What should be debited and what should be credited? We're going to look at these in more detail in the slides to come. First, business transactions must be measured, as we discussed, in 3 ways. The first way, recognition. It would seem that this would be not a big deal. When did the transaction occur? Well, the recognition point is a very important question to answer. The recognition of the transaction, determining at what point did the transaction actually occur, where we have a recordable or recognizable event. So let's give an example. An example of, say, a desk. On page 92, they use the desk example. When did the transaction occur? Suppose a company orders a desk, receives it, and pays for the desk. Which situation constitutes the recognizable event? Is it when the employee sent a purchase requisition to the purchasing department to purchase the desk? Number 2, is it the actual purchasing department sending the purchase order to the supplier? Or number 3, the supplier ships the desk? Or option 4, the company receives the desk? Or option 5, when the company receives the bill from the supplier for the desk? Or lastly, would we recognize it when the company pays the bill? The answer to this question is important because it affects the financial statement of the company at any of those various different dates and points in time. In addition, we want to make sure that we don't record the purchase of that desk more than once. So, according to accounting rules, the transaction should be recorded when title passes from the seller to the buyer. And this recognition point depends upon what was agreed upon between the buyer and the seller. Did they agree that the desk title would pass at the shipping point, or did they agree that the desk's title would pass at the destination point? So in either of these 2 instances, title would most likely pass somewhere between question number 3 and number 4. The supplier ships the desk or the company receives the desk. However, some small companies might, for simplicity's purposes, record the transaction when the bill is received or when the bill is paid. Whatever option a company chooses, the primary thing is to be consistent and use that same approach with all transactions. Now let's look at the valuation question. The question here is, what is the monetary value that we're going to use to record the transaction? What value should be placed here? GAAP says that business transactions should be valued at their fair value, or the exchange price between the participants when they occur. So, in most instances, the exchange price is going to require us to apply what we call the cost principle. The historical cost or the acquisition cost of a particular item is the cost that we would use, or the value that we use for a transaction. We often use the cost because it is easily verified. So it is often said to be the best, most consistent approach to valuation. This may be, the exception to this might be investments, because the fair value or the market value of investments is constantly changing. Let's look at an international practice with regard to the valuation question. The challenge for fair value is also addressed by the International Financial Recording Standards. And in international accounting, the fair value is a major challenge in merging international financial reporting, because both the International Accounting Standards Boards and FASB, Financial Accounting Standards Boards, are committed to ensuring that there is consistency in how we practice the valuation approach. So, fair value is the price at which an asset could be sold or a liability settled between the independent parties according to international practices. The challenge here is it could be difficult to measure what fair value is. For instance, there may be, for some types of items, no true what we call selling price, or it would be hard to determine what the selling price is because that item is so specific, or that item is so infrequently sold, so that it becomes a very difficult item to actually place a fair value upon. So this becomes a continuing challenge that the International Accounting Standards Board and FASB continue to address. The last piece of the measurement issue is the classification. And in this question, we're looking at which accounts are affected by the transaction. Businesses usually maintain, I shouldn't say usually, they maintain a chart of accounts to choose for each type of transaction. So if we have an example of tools, and those tools are often used in the repair of the equipment for the company, we have the question of, should the tools be included in repairs expense, which affects the profitability and stockholders' equity of a company, or should they be included in equipment as an asset? So a company has to decide what approach they're going to use, and then they again need to be consistent. Another example would be if CVS buys paper towels to resell to its customers. If CVS is buying those paper towels to resell to the customer, then clearly the cost of those paper towels would be recorded as an asset in the inventory of the company. That would differ from if CVS buys paper towels to use and clean its own store shelves. If it was using those paper towels to clean its store shelves, then clearly those paper towels would be recorded as an expense. So you can see two examples of the classification issue and the importance of trying to determine how those accounts, those transaction accounts should be classified. How is this important from an ethical standpoint? If a business does not consistently follow rules and apply GAAP to its measurement issues, fraud could become a factor in the business. I'll give you 3 examples of different companies that used fraudulent measurement practices that affected the company's long-term viability and many of the company's stockholders. First, we have Computer Associates. Computer Associates violated the guidelines for recognition. What they did is they violated the recognition by keeping its books open after the end of its true fiscal period. As a result, they recorded $3.3 billion in extra revenue. Clearly a violation of ethical accounting principles. Second, Enron. It violated the guidelines for valuation. It valued assets it had transferred to related companies at more than their actual fair value. And then lastly, WorldCom. It recorded assets as expenditures that should have been classified. It recorded asset expenditures as assets when they should have been classified as expenses. WorldCom, now known as MCI, was the largest financial fraud in the history prior to the financial crisis of 2007 and 2008. Over several years, WorldCom recorded assets that should have been classified as expenses. This had the effect of understating the company's expenses and overstating its net income by more than $10 billion. So clearly you can see how these examples of the importance of the measurement issue can impact the actual financial statements and long-term viability of a corporation. So, take a few minutes to answer these questions. You will be sent a link to the Google document to answer these questions there. Let's move on into learning objective number 2. Explaining the double entry system and the usefulness of T accounts. Our accounting system has evolved over time and began technically back in the Renaissance period. The double-entry accounting system was actually created by an Italian named Fra Luca Pacioli in 1494. It was actually based upon what we call the principle of duality, meaning all accounting systems are based on 2 transactions or 2 accounts at a minimum being affected by each transaction. We must record at least 1 debit and 1 credit so that the monetary value of the debits and the credits are equal. The whole system must always be in balance. Every economic event will have 2 aspects, an effort and a reward, a sacrifice and a benefit that offset or balance each other. The total amount of the debits will equal the total amount of the credits. Accounts in the double-entry accounting system are the basic unit of accounting storage of accounting data and used to accumulate the amounts from similar transactions. The T account is a tool that is used to analyze transactions. There are 3 basic parts to the T account. The title identifies the asset, liability, or stockholders' equity account. The left side of the T account, also known as the debit side, and the right side, also known as the credit side. This tool is used by accountants to quickly analyze a transaction. It is used as a tool to analyze transactions into the debit and credit parts. And the ledger is the actual transaction. The ledger is the actual place where the transactions, the account's balance is maintained. Let's look at an illustration of the T account and how it's used. We can see here how there are balances put into the cash account, and then at the bottom we have what is called the footings or the totals, and then the difference between the debit and the credit side is what we call the balance. The rules for the double entry accounting system are just simply that every transaction affects at least two accounts. A debit of an asset account increases that asset account. A credit of an asset account decreases that asset account. Credits to liabilities and stockholder equity accounts increase them, and debits to liabilities and stockholder equity accounts decrease them. The rules of double entry accounting are that the total debits must always equal the total credits. Dividends and expenses are deductions from stockholders' equity, and thus transactions that increase a dividend or an expense result in a decrease to the stockholders' equity. The normal balance side of an account on which its balance is the normal balance side of an account is the side on which the balance is usually maintained for that type of account. It is also the side in which the account increases on. So as you can see in this chart, there's a little breakdown of what side increases an account's balance and its normal balance, and what side decreases the account and relative to the normal balance. The stockholders' equity accounts represent the legal claims of the stockholders to the assets of a corporation. By law, investments by stockholders and dividends must be accounted for separately from revenues and expenses for both income tax and financial reporting purposes. So as you can see in this chart, we have in the orange area, your assets equal your liabilities plus your stockholders' equity. But your stockholders' equity is made up of two components, the common stock and the retained earnings. You can see that the common stock is your investments by stockholders, and then the factors that affect your retained earnings are your dividend, your revenues, and your expenses. The revenue and expenses are shown on the income statement, whereas the dividends are not an ordinary expense of the business, and therefore they are shown only as a reduction to the retained earnings balance of the company. The law requires that capital investment and dividends are separate, so therefore those items must be separated for tax, reporting, financial, and other purposes. In addition, management needs to keep a detailed breakdown of revenue and expenses for budgeting and operating purposes, and so therefore those items are tracked separately. Additionally, management must be able to determine its primary goal of profitability, and so therefore they need to be able to account for and record revenues minus expenses. The accounting cycle consists of a series of 6 steps whose basic purpose is to produce financial statements for decision makers. The first step is to analyze business transactions. Using the source documents, again, we're going to look at what accounts increased or decreased. The second item is to record the transaction in the journal. This is where we would apply the rules of double entry. In our journal, our transactions are going to be recorded in chronological order. We would enter the date and the account that is debited and the account that is credited and the amount for each. Third, we have the posting of the transactions from the journal to the ledger, and the ledger is where the ongoing balance of the account is maintained. We use that ledger information to prepare the trial balance and confirm that the account balances are in balance. And then fourth, we would do the adjustments to the accounts and prepare the adjusted trial balance. And fifth, we would prepare financial statements to communicate the financial position and profitability of the company to decision makers. And then lastly, we close the accounts and prepare a post-closing trial balance. This just provides a basic overview of the accounting cycle. It's just a pictorial representation of what I just explained on the previous slide, those 6 steps. Now, take a moment to apply what you have learned by listing the accounts and the dollar amounts for each account on their normal balance side, and then just complete the basic accounting equation. Again, you will receive a Google document where you can answer these questions. Thank you for listening and have a great day.